for tuning into BQ Conversations. Our guest today is Neelkanth Mishra of Credit Suisse. Needs no introduction, really, Neelkanth. It's really a pleasure talking to you today, just as we wrap up 2022. Thanks for this.
Thank you for having me over. Thank you.
And the pleasure is ours. So, Neelkanth, what does your crystal ball tell you about what is in store, considering all that's happened in the last 12 months and arguably in the last 3 years?
So the last 12 months have been fairly volatile, though at the end of it, it's all turned out well for the Indian economy. It is helpful to divide the market performance into three parts. The first is the 12-month forward earnings. As you know, the market level is the 12-month forward EPS into the price to earnings multiple that you apply on that. And so even the PE, I would like to divide into two parts. One is the global market PE and India's PE premium, right? So there are three parts to the market level. One is the 12-month forward EPS. Second is global market PE. Third is India's PE premium. In the last 12 months, the performance has been driven almost completely by 12-month forward EPS and India's PE premium expansion. The global market PE has actually been contracting. Going forward, as we put on the, as you said, the crystal ball, and we do some gaze into it, it is very reasonable to expect that earnings will keep growing. So currently, if you take the FY24 and 25 EPS, in December 23, the 12-month forward EPS will be 15% higher than what we are at right now. So it is reasonable to expect there will be cuts to that. So, but still, I think low double digit kind of growth should be expected. The challenge I see is with the PE premium. So the Indian market premium to the world is now expanded so dramatically that it has reached levels from which it has been higher only 3-4% of the time in its history. Now, there are people who believe that this premium can keep expanding because domestic flows are going to remain quite strong, that in the Indian economy will keep doing much better than what the global economy is doing. And I get all of that. But the investing process deals with probabilities, right? So it is, if something has never happened in 25 years or has rarely happened in 25 years, betting on that is unwise. So then we are back to thinking about what happens to global market PE. And there too, my expectation is that PE multiples globally will moderate from here because the risk-free rate, which is the US 10-year bond yield, would remain much higher than it was in the 2011 to 19 period. And the equity risk premium, which is the excess return that investors would want, given that equities are a slightly riskier asset class. So that ERP is also low. So as we see growth shocks globally, as we see geopolitical concerns manifesting themselves in policy decisions, you may see that ERP also bumps up from where we are now. And which means that global PE may remain muted. India's PE premium is maxed out, and therefore the growth in earnings pretty much puts a ceiling on what the market returns can be.
The consensus view that I get in the last 15 days after talking to a bunch of people is that there's a very high probability that there could be a global pullback because of the recessionary phase that even the US might enter into, and therefore world markets will come off. India is not immune. What I don't hear is that if India is trading at such a big premium, could the corrective move in India, despite its recent favoritism amongst global investors, could the corrective move in India be sharper than what we may see in some of the markets which have not done as well in 2022?
That's an excellent question because most people think that, and there's a self-serving nature to it, that given India's growth prospect, they will not sell India. But that is not how investors trade, right? So if market A is trading at 20 times earnings and market B is trading at 10 times earnings, If they have to sell something, they would rather sell at 20 times earnings. And therefore, and also remember that they get very easy liquidity here. That is, the domestic inflows have been so strong, and therefore the market has been supported despite a heavy wave of selling in the first half. That it is easier to sell this because in some of the markets, if you go out to sell, you will effectively destroy the market itself. Here, you can. There are people on the other side who are willing to grab it. So there will be heavier selling for sure because India has been an outlier. But will that be enough to to bring down the market by say 15-20%? I am not convinced by that because see the domestic flows and it's effectively what I would call structural behavioral flows. Right, these are not discretionary flows in the sense that you have $7-8 billion a year coming in through the EPFO. You have maybe 10-12 billion, maybe slightly less in good years. Meaning, insurance flows are generally mean reverting. Meaning, they in September 21 quarter they sold a lot. In September 22 quarter they bought a lot. So because when the market goes too high, they start trimming and vice versa. So that's another $10-12 billion. And you must have seen insurance premium growth November also was 20% year on year. And with all that IRDA has done, insurance penetration will rise from here. People will invest, they will get more funds. And then there is the SIPs. Now, they may not be $18-20 billion, but there will be $15 billion. It's not going to go negative. So net, there is still $35-40 billion of flows that are coming in through these channels. So if it's a moderate global concern, I don't see a problem. If there is a serious global concern, in the sense that there is a potential accident, that some major real estate market globally tanks and carries down the local banks along with them, and then there's suddenly a freeze in global dollar funding, then India will be badly hurt. And so there is a possibility. It's like hitting a wall because you need $85-100 billion a year to fund your current account deficit. And if even in the short term, if that slows down to zero or reverses, because remember that there are a lot of Indian companies that have taken dollar loans and they will struggle to roll them over. And so for a 2-3 month period, you could see the economy absolutely sort of slamming against a wall. But that's an event risk. That is not something that you can sort of model into a base case scenario.
Okay, and I would reckon that while you can't even model in, you probably not even think of it as a base case. It's an outlier black swan kind of an event.
Correct. So you should be broadly. So it's I'm told in economic terms it's called the Knightian uncertainty, that it's unforecastable risk. But as a forecaster or as someone who needs to have a forward-looking view on the market, you try to bring it in by being perhaps slightly more conservative in your sector preferences than you would have been otherwise. So, for example, focusing on some domestic pharma exposure, preferring staples over slightly riskier things, and then even on prioritizing domestic cyclical even more than you would have versus global. So you do make some minor tweaks, but yeah, I mean, it's you cannot put a probability to a 10% probability or a 15% probability. And even if it is 15%, so what, right? I mean, so what does that mean? It's very hard to model it, but it should affect our sector allocations to some extent.
Got it. I won't talk too much macro on this conversation, but just one question. I mean, does the broader macro, is the broader macro for India supportive, or could it turn disruptive? I mean, I know crude is kind of variable and it's behaving well right now, but just thinking out loud, is the broader macro supportive or not so?
Meaning the external macro? No, I think the domestic drivers of growth are mostly, or other the drivers of growth are mostly domestic, and that's something that should hold up, right? So like construction activity. So dwelling construction, and we've been talking about this since November last year, that look, there is a multi-year cycle in dwelling construction which is imminent. It is now starting to play out. My apprehension is that prices of real estate are going up a bit too fast, but maybe it is a necessary condition for developers to start accelerating construction, because the upside for them if they deliver more houses is that much more. But still that activity is on. In the state government spending, there's evidence now that that's coming online. The government cash balance with RBI has fallen quite sharply. So from like 5.6 lakh crores to less than 2 lakh crores. This is despite strong tax collection. So if the tax collections are strong, they're borrowing more or less, they're slightly less than expected, but and their cash balances are falling, which means they're spending. That's arithmetic. And all of this means that domestic drivers of growth are very much intact. Fiscally, the higher tax to GDP gives a lot of comfort to people. The inflation indicators, and of course the recent downward is sort of the inflation coming in lower than expected was mostly because of vegetables. They tend to be very volatile, but the good thing is that there is a supply response showing up in all major vegetables, even in eggs and lots of other things. So the inflationary pressures are also easing, and that brings us to the external economy, right? So when you're thinking about macro factors, I think the slowdown in exports is something we should be very worried about. Just to give you perspective, if you were earlier modeling $100 per barrel oil, and now you have $80 per barrel oil, there is a $20 saving, which into 1.5, because we know we consume about 1.5 billion barrels a year. So that's like a $30 billion saving. But if your exports, and remember that oil is falling right now, despite supply still drifting down, which means that it is a serious demand problem.
Right.
And so if your exports fall by 10%, you're talking about a $40 billion slip up. If your dollar loans, so every year we tend to get $15-20 billion of external commercial borrowings. Now that is and that is a net basis, right? But on a gross basis, there is a lot more that gets rolled over, meaning this is a repayment and then you take a fresh loan against that. I mean, to pay for that. If that stops, that plus 20 could become minus 20. So that's like a $40 billion swing again on the balance of payments. So the reason to be worried about balance of payments has shifted from high energy prices to weak exports, as well as a potential risk of capital outflows, especially on the debt account. So that's something that I worry about. But on the other domestic drivers, I think numbers are very strong.
Okay, so if we have a bump, would you reckon that bump would be something that you would tell your choicest investors to log on to, depending on what your view is for, say, FY24, FY25?
Oh, absolutely. So bump, I mean that if there's a negative disappointment and
a wobble, sorry.
Would you be buying? Oh, absolutely. So that's what I tell. I mean, our team, most investors, that every market move is is a move lower an opportunity to buy or just accelerate selling, and if a stock moves up, I mean, should you be trimming or should waiting for a correction? So in this case, given that the medium-term outlook is so robust, I would be with buying on dips, but remember that everyone is waiting to do that, right? And we are also seeing a flood of domestic savings, and this is just plumbing, right? So this is where the pipe is emerging, meaning there is savings going into a whole range of pipes. This pipe has suddenly become much broader, to the extent that Indian equities are now more expensive than sovereign bonds, right? So the equity risk premium on Indian GSEC yields as risk-free rate is now negative, which means that you'd be better off buying sovereign bonds on an absolute basis. Forget about risk-adjusted basis. So I think the plumbing is also supportive of markets. There is a whole army of people out there who believe buy the dip is a strategy. that if the market falls, just go and buy it. And the fact that for 15 months we've not seen the market do anything at a headline level is perhaps not sufficient for the buy the dip crowd to lose their enthusiasm. And so if the market falls 10%, it is almost guaranteed, unless there is a major global accident, it is reasonable to expect that people will start buying, and there will be enough number of people. So, which is another reason why I don't expect the market to fall a lot. I think there will be more of a time correction.
And turn of the broader market seems to come to the fore, so to say. The jury split right down the middle about whether large caps and safety will find favor or the others will find favor. Your sense in your note?
I think given all the uncertainty, so there is a preference for the large caps. Remember that EPFO only buys Nifty ETFs. Most insurance funds are more likely to buy the large caps. There may be some who are punting in the small caps, but generally their objective is to be in large liquid names. And the SIPs also tend to be, more towards, in terms of the size of funds going, would be more towards the larger liquid funds. So, meaning not the liquid funds, but larger, AUM funds. And therefore, the preference for me would also be on the large caps. On the mid caps, I think the advantage is that fundamentally they are less exposed to the world. They're much more exposed to India. And so earnings wise, they should be better off. But my apprehension is that, at a time of uncertainty, the risk appetite, when it weakens, it tends to affect the mid cap PEs a lot more. And so that's, I mean, I'm not saying this is the right way to think about it, but from a market forecasting perspective, I can't see any other way to think about it. And also remember that 52% of mutual fund ownership is in the non-retail SIP, non-SIP retail, meaning that 52% of the AUM of about 23 lakh crores in equities is with investors who have made discretionary allocations, lump sum allocations into equities. Now, for many of those, the attractiveness of bonds, or FDs, or real estate, or other asset classes is something that is likely to moderate investment going forward. And it's very hard to sort of triangulate to who exactly buys the mid-cap stocks, but this, I think, is the crowd that is a lot more savvy and is invested in the mid-caps and small caps. So as they find that other asset classes are becoming more attractive, it is possible that the mid-cap, small caps can continue to drift lower, and I would still prefer the large caps.
Got it. Last couple of questions, Neelkanth. When I look at this, when I scan the list of the haves and the have-nots, the haves list of 2022 has a fairly different texture in that suddenly PSU banks since October came to the party. We had defense being active, but it really came to the fore in 2022 as opposed to 2021. So very different texture of components compared to any of the preceding years. What's your sense? Do you think that that list dramatically changes in 2023? Or do we see some bit of continuity because the fortunes may be multi-year and not necessarily of a limited time span?
Absolutely. So I do think so. I agree with your last statement. Just because the Earth passes a certain point in the orbit around the sun doesn't mean that there'll be a fundamental shift in how businesses and markets think. And I still think that financials, despite all the outperformance, are still on a 12-month forward basis are still cheap. The risk to earnings cuts in financials is quite low. The possibility of a of a cycle of bad loans coming up is at least 12 months away, if not 24 months away, and therefore the sector looks attractive. Though I know it's a consensus buy, has been a consensus buy for a very long time, but I think that that sector will still keep doing well. The converse is IT. So in IT services, there are people who think that the and for right reasons, right? I mean, I also am tempted by those factors that strong balance sheets, good cash positions, good management, good desire to pay back. Some of them are trading at 4% dividend yields. Why shouldn't we buy them now? And our fear is that these are exactly the reasons why they are still not corrected, and they're still not corrected enough. There has been a fear of missing out. That my God, now these stocks have corrected, so let me go and buy them. So the recent rallies that we have seen have been more about FOMO than any change in fundamentals. In our view, and our IT analyst put out a phenomenal note last week, where he flagged that when the US sees a very sharp growth or a sharp deceleration in growth, the earnings cuts may be minor, right? So 2-3% at most, but the reduction in PE is much more sharp, and so that is still ahead of us. US unemployment rates are still too low. It is when big job losses start showing up is when the constant currency growth expectations for some of these companies will get tested. And it is when those sentiments start turning, it is when management starts to talk about order cancellations, about their customers coming under stress, is when would be a good time to start buying the sector.
Got it. My final question, really, before I let you go, I think you broadly spoke about it, but I still want to understand. Would you believe that portfolios focused more on the domestic side might be better off in a volatile global environment?
Yes, absolutely. And so we are underweight IT. We have zero weight in metals in our model portfolio. We believe even going forward, even refining margins can come under stress. So there is a clear preference for domestic cyclical. So financials, construction, cement, and then staples over discretionary, because we think that low-income jobs are coming back, and so incrementally, this sort of staples demand would do better than discretionary demand. So it's not to say that discretionary demand will weaken, sure, but incrementally staples demand can do better than discretionary demand. So we are definitely more positive on the domestic side than the export side.
Got it. Neelkanth Mishra, always a pleasure talking to you. Thank you so much for the same today, and have a great holiday season.
Thank you, Neeraj. Same to you, and thank you for having me on the show.
Thank you. And viewers, thanks for tuning into this conversation.